So you finally decided to start your own stocks portfolio and you downloaded that trading application which everyone is talking about, and you see a bunch of ticker symbols and random numbers. So you get super confused, you close the application and you never talk about it again in your life. With thousands and thousands of stocks to choose from, which ones should you choose and invest in? Should you choose what the experts are recommending, or should you YOLO your savings into the next meme stock? I was going through the same confusion when I first started, so in today's episode I'll show you step by step on how I pick individual stocks. So let's get to it. Step number 1 is to determine the purpose of your portfolio. I know this is such an obvious step, but most people just skip it. So, the ultimate goal for investors and traders will always be to make money, but you need to specify how do you want this money to be generated and when do you need it. Are you investing so your investment will grow to supplement your income during retirement, or do you feel that your wealth will lose its value due to inflation with time and you want to preserve it, or are you looking for some additional monthly income? Defining your goal in the beginning is so crucial because each goal has its own strategy. There are mainly 3 types of investors. Type number 1 are dividends-oriented investors. Those people buy and hold good dividends-paying companies as long as they remain paying them that quarterly or yearly dividends. Those companies tend to be low growth, such as utilities or banks. Other options might include bonds or REITs. Type number 2 are investors who are looking to preserve their wealth. They don't like to YOLO their money into risky investments. They tend to invest in blue chip companies. Those companies tend to do well in good and bad times, and they don't like IPOs and stay as away as possible from them. The third type of investors are those who are looking to appreciate their investment with time. In other words, they are looking to 10x to 20x their investment. Those have a good appetite for risk and are willing to YOLO all of their investment into the next Tesla or the next Amazon. So after you determine which type of stocks portfolio you would like to start, it's time for step number 2, which is to find a stock or a company to analyze. So where should you go looking for a stock or a company to analyze? The easiest way you can do is by going to your local shopping mall and observe the shops with a lot of customers and Google if it's a traded company. The other thing that you can do is observe the things that you buy on a regular basis. Like for example, I buy Coca-Cola all the time and I buy almost everything online through Amazon. Also, you can check what other big investors are investing in, like for example, Warren Buffett. And you can also ask yourself which businesses are you most familiar with. Warren Buffett quotes this, the circle of competence. If you are someone who works in utilities, you can search about the different traded utility companies and compare between them. Or if you are someone who is a technology geek, you can do the same. Search about different technology companies and compare between them. After you narrow down your research to few companies, it is time to narrow it down further by asking some questions to determine if those companies are a good investment or not. Let's say you want to start investing in company X. What are some of the questions that you can ask to determine if this is the right company to invest in or not? You can start by asking, does the company have a profitable underlying business? Does it have a lot of loyal customers? Is it always ahead of trends? Is the company a market leader or have a good potential to grow? Finally, you can check the different financial websites to have an idea about the different sectors and the different traded company within each sector. You can go to Yahoo Finance, MarketWatch, or the Wall Street Journal to find more. I will leave all of their links down below. After you have found the sectors and the specific companies that you are willing to invest in, it is time to analyze those companies further to see if they have an economic moat. There are basically 2 types of analysis, a quantitative analysis and a qualitative analysis. Let's first talk about the quantitative analysis. This type of unbiased analysis mostly deals with the financial performance by analyzing the financial statements, which are the balance sheet, income statement, and the cash flow statement. And it focuses on numbers such as a profit, margins, debt ratio, and earnings multiples in order to see if the business is making money or losing money. And are the profits growing with time, and how much free cash does the company hold? And also these numbers are plugged in some mathematical tools such as the discount cash flow models to determine what is called by the fair value of a stock, which is usually less than what a stock is currently traded at. While the second type of analysis, which is the qualitative analysis, which deals with the characteristics or the qualities of the company or business. For example, the quality of the management, their ethics, reputation in the market, brand value, and consistency of business strategies. In the qualitative analysis, you have to dig deep into the management and have some knowledge about their background and capabilities and also their management style. Both the quantitative and the qualitative analysis can be used together to determine if the business is solid and worth investing in. And also they can be used to determine the fair value of the stock and project future growth potential. The final and the most important step is portfolio management. The first rule of portfolio management is diversifying your account. You can diversify your account by investing in different sectors such as healthcare, financials, technology and energy, and you can diversify even further by investing in different companies within each sector. The second rule is not to allocate more than 10% of your entire portfolio into one stock. Like for example, if you are investing $1,000, don't put more than $100 into one stock. The third rule is to allocate more weight to stronger companies. Like for example, if you are investing in different companies within one sector, try allocating more funds to the stronger companies which have stronger financials or stronger fundamentals. The fourth rule is to review your portfolio at least once a year to reallocate your portfolio, like for example, to take some profit and reinvest it. Finally, rule number 5 is don't sell a stock based on the price unless the fundamentals have changed. Like for example, if the stock's price went down by 50% but the business is still solid, try buying the dip instead of selling. In summary, find a leading company with a strong brand and reputation among its competitors with solid fundamentals and great management leading it. So this is how I pick individual stocks to invest in. I hope this video was beneficial, and if you have any question, leave them down below and I'll try my best to answer each and every question. Don't forget to smash the like button for the algorithm and subscribe for more content.